Look at that. So week 3. This is the third and final week of the accounting process, if you like. Again, week 3, finish the accounting process, undergrad, 5 weeks. All right, so we have condensed a lot of material and a lot of exercise, a lot of intellectual kind of challenge in the first 3 weeks so far. We appreciate that, as long as you appreciate it. By the end of this sort of week 4, 5 and 6, the learning curve will flatten off and we'll start to think about how to use this information. We're already really, when you reflect on it, we're already really starting to think about how to use the information now, particularly with some of the questions that we're talking about this week. So, accrual accounting concepts, not the sexiest topic not the sexiest label for the week. I've got to think about that, how to make it a bit more sexy, but yeah. When we're talking about revenues and expenses, I mean, it's exciting, but it's probably not sexy. Well, that wasn't meant to be funny. So, in terms of the learning objectives, well, it kind of was. I mean, if it wasn't meant to be funny, it was a bit sad. But in terms of the learning objectives, I reckon the first 4 are the main ones that I want to focus on. So understanding the difference between cash basis and accrual basis of accounting, I'm going to talk a little bit about that. That will come up at some stage in the semester. You know, to be able to know when cash accounting is appropriate, to be able to know the downfalls of cash accounting, where you've got certain conditions in place. Explain the criteria for recognising revenues and expenses in financial reports. We've kind of started on that trail already. Right? I just want to put a little bit of structure around that. Some of the stuff this week is, you know, in the workshops that we cover, get at that. So there's a little bit of reinforcement of last week. The adjusting journal entries, prepayments and accruals, so 3 and 4 are new. So this is entirely new. But I just want to, but the rationale for those comes out of the objectives 1 and 2. So if you get 1 and 2, then you'll see the need for adjusting journal entries, and then just a little bit of process in terms of preparing and recording the adjusting journal entries. We'll finish off with a bit of a chat about the role of the trial balance in this process and closing entries. I want to finish off by talking a little bit about earnings quality as well. You'll hear that term all the time. So having come out the other end of a session like tonight, where I introduce the judgment in and around the recording process, my point is going to be, now we're in a position to really understand a kind of higher level whether the accounting for a particular organisation is good accounting or not, or what's their real performance. And that's when the benefits of being able to understand the accounting process really come home to you and really provide you with a personal value. All right, so, what's that say? Citrix receiver. Do I need to log on? Anyone know that? Oh, you don't see it anyway. All right, I'm seeing that. I'm seeing a little sign come up to say log on. All right, so if you don't see it, we don't care. I don't think. Okay. Uh-oh. All right, maybe we do care. Let me just log on. This is really good for the recording as well. Okay. There we go, we're up and running. So, accrual-based accounting versus cash-based accounting. I think we've sort of touched on this before to the extent that accrual-based accounting is focusing on recording revenues and expenses when the substance of the transaction occurs. All right, so when you earn, and for us, the language I've used so far is when you earn the revenue and when you incur the revenue. So, and when you incur the expense. So under accrual accounting, you can recognise revenue when you've done something and therefore you've got a legitimate claim on someone else to pay you, and when it's reasonable that you're going to be able to collect that money, which is a fair way away from what people outside the field of accounting would understand by the term revenue. So I think it's safe to say that most people would equate earning revenue or income, we've been better off. But most people, I think, would assume that being better off in terms of earning revenue would mean you receive cash. But you don't receive cash. You don't necessarily receive cash. Obviously, there's an assumption that cash is coming, right? Or that you're somehow better off. One, for you to have being able to, for you to be able to have recorded revenue. But I guess the key point is that cash flow does not need to occur for revenues and expenses to be recorded under accrual accounting. That means that there's an element of judgment involved. And that means for groups like ours, we need to be careful to understand what profit, revenues and expenses is being recorded, as well as how cash is being recorded, just to equate them to, provide us with a benchmark. And I'll get back to that at the end of the session. Compare that to cash-based accounting. So cash-based accounting, revenues are recorded when cash is received, expenses are recorded when cash is paid. That's it. Really cut and dried, really black and white. I think a little bit more simple. Okay? Question is, what are the costs and benefits of using accrual accounting versus cash accounting? Cash accounting, more simple, more straightforward, less judgment, more objective, less information though. Particularly if you have to provide information about your performance from period to period. Okay, let me give you a couple of examples, and then I'll go back and we'll tie this discussion up. So let's have a look at a really simple example. So cash versus accrual. So we've got a business paid $50,000 for purchase paint, and we paid employees in year one. We then go on and do work and receive the work in year one and receive the money for the work done in year two. Okay? Now, you might say, well, are we waiting a year before, in between forming a business and doing the work and getting paid? This might have occurred in June, and our year end is June 30. So we purchase the paint, we do the work in June, and we get paid in July. Okay? Really simple situation. Under accrual accounting, in year one, if we've earned the revenue, we've done the painting, we recognise the revenue of 80,000. We recognise the expenses of 50,000. We recognise that as a result of what's going on, we're $30,000 better off, even though we haven't received it. Under cash accounting, the only thing that's recorded is the expense. Under cash accounting, $80,000 revenue occurs in year two. Under accrual accounting, we've recorded the transaction. Nothing more needed to be recorded in relation to that transaction in year two under accrual accounting. So the question is, which is the more sensible, which is the more representative method for a transaction like this? Right? It's accrual accounting, right? Because are you $50,000 worse off? Did you perform poorly in year one and really well in year two? No, you didn't, did you? They are connected. A, they're connected. And B, if you're comparing year one's performance against year two's performance, you need a solid, you need a consistent basis for comparison. All right? Wherever you're I know a lot of you guys aren't going to major in accounting. You might be majoring in the arts, or you might have a background in business or marketing or HR, etc. If you are working in a profit centre, right, so you receive revenue, you earn revenue and you incur expenses, whenever there is a time between revenues and expenses, you will need to consider accrual accounting. Right? In our department, in faculties right across the university, we receive research grants, and we might get the research grant for 3 years. We receive all the money in 1 year, and we've got to spend it in over 3 years' time. If we used cash accounting, our results would be all over the place. Okay? That's not to say, though, that cash-based accounting is entirely inappropriate, and in fact it might actually be appropriate for some businesses. All right? As I said, it's more simple. Accrual accounting provides more information. It provides a better basis for planning and a better basis for comparison across periods, okay? But there is some judgment involved. I mean, in year one, going back to the example that I just showed you, in year one, there's obviously an assumption that we're going to collect the cash, right? Otherwise, it would be misleading to record the $80,000 revenue in year one. If you don't end up collecting the cash, then we've got a problem. Whereas under cash accounting, you only record it once you collect it. So there's an element of certainty under cash accounting that's not there under accrual accounting. Okay? It costs you more to implement accrual accounting. You probably need an accounting software package. You might need a bookkeeper. You may or may not need your accounts to be audited. But if you are, wherever there is a time lapse between you incurring expenses or receiving amounts and paying for them, then the chances are accrual accounting is probably going to provide you with more benefit. Another factor to consider is what information the stakeholders that you report to want. So, you think about a local restaurant. So who might, let's say we've got a business that's a local restaurant. Who might be interested in that? Well, there might be employees. They want to know, as employees, what do you want to know? You want to know if the company is generating enough money to pay you, right? Otherwise, you're going to look for another job. You want to know what whether your entitlements are safe and things like that. The bank might need money, might need information, but they typically want to know whether you're going to earn enough money to pay them back. Cash flow, assets, right? So a local restaurant might be able to get away with just cash accounting. But an arts organisation or a large corporate, typically arts organisations absolutely survive. The difference between them surviving or not is on their ability to get grants. And I know the arts organisation that I'm involved with, Multicultural Arts Victoria, they get a lot of grants towards the end of one year and they spend the money the next year. Right? And so when I'm kind of reporting to the board members will go, the cash flow is going out. Yeah, that's okay, because it's a cash flow that we earned in November, December last year. Right? And so we've got to provide a mechanism to enable them to see that, on a project basis, we're not spending any more than we have to spend. Sorry, that we're not spending any more than we've earned already. We're not overspending, is my point. Obviously, a large corporation, whenever you've got a situation where transactions might not fit within one accounting period, then accrual accounting is typically preferable. But, tradespeople, small proprietors, small businesses might be able to survive perfectly well on a cash basis. Okay? So in tying this point off, make sure you are able to explain the difference between cash and accrual accounting and argue the benefits of either. Remember that diagram I put up in the first week? A balance sheet will tell you that your position has changed over time. The profit and loss statement will tell you how, but it doesn't tell you anything about cash. It's the cash flow statement that tells you about cash. So the bottom line is information about cash and profit is needed. But if you're measuring performance, the income statement based on accrual accounting is the key. Okay? So what next? So we're using accrual accounting. So what? What does that mean for revenues and expenses? Well, there's one more complicating factor for me to put in. Remember in week one, no doubt you do, no doubt you may. Let me just put page 44 of the textbook, so the period assumption. Remember what our responsibility is here. What we've got to do is we've got to divide the life of the business up into chunks. 1 month, 6 months, a quarter, etc. And we've got to report the performance between two periods. It's all right, personally, because you can tell what wages what salaries and wages you've earned between two periods, because you get paid for it. This is for this to this. Okay? But profit is different because transactions don't always fit within the 1st of July 2016 to the 30th of June 2017. They don't always, all transactions aren't necessarily complete. Over the life of the business, they'll all be complete. So accrual accounting versus cash accounting, over the whole life of a business from the time it starts to the time it's wound up, they will be the same. because all transactions will be known, all cash flows will have occurred, so they'll be the same. It's just when we've got to divide the life of the business up into periods and report performance in those periods that the choice of accrual accounting is critical. Okay? But that means we introduce judgment. And here we go on a kind of a little, all right, we've got a little basis now. Let me stretch you a little bit. We introduce judgment when the need for accrual accounting and the need to report periodically means that judgment is required. And essentially, you think about it, essentially what companies are doing is companies are reporting on their own performance. It's like me saying to you this. Let me give you a scenario. This is hypothetical, right? But let's say I said to you there is no exam for this subject anymore. I've changed my mind. Bless you. Not all of you, just, right? There is no exam for this subject. Instead, what I want you to do is I'm going to give you a few general parameters, and then I want you to write me a report on how much you know, how much you've studied, and what mark you deserve. Is that a good idea? All right. Okay. I guarantee there's no one in the room that's going to go, no, I don't know anything. I'm crap at this and I haven't worked hard, so I deserve a bad mark. What you're going to do is you're going to interpret the parameters I give you, and you're going to try and give me this complete story about what great students you are, and you are great, and how you deserve a fabulous mark. Right? It's completely rational to do it, because you are reporting on your own performance. So, a bit of a trivial example, right? But when you think about companies, what are they doing? They're reporting on their own performance. If they release a profit, people get paid more. They make investments, share prices go up. There is economic consequences associated with reported profit. People get hired or fired. All right? Executives get huge bonuses. Price of options go up. Okay? Really interesting, right? Because we've got significant judgment over revenues and expenses. All right. Let's probe that a little bit more. This is as technical in terms of accounting as it gets, and I don't want you to focus on the actual specific words here. But what accounting standard setters have tried to do is to try and narrow down the basis for which companies might exercise judgment and record revenue when they shouldn't. All right? So the difficulty is, so if I said to you, you need to record revenue when you've earned it and when it's reliably measurable. So that invites two problems straight away. One, you're possibly going to record revenue that you haven't earned, right? That we might not agree whether you've earned it or not. And two, you might value it more highly than what really you might be able to collect. So there's they're really two really basic or really kind of immediate basis for which you might... This is freaking me out. A really simple basis on which you might exercise judgment. So what accounting standard setters have tried to do is release some more accounting standards guidance that would help us to figure out when revenue should be recognised. Okay? Which is kind of ironic, right? Because 500 years ago, and this is not a history lesson, but 550 years ago accounting was created. We're still trying to figure out what revenue is. It's a bit odd, but that's okay. So really when you think of, so IFRS and the relevant standard here is the AASB. So AASB 15 has got the same tests. So a new standard as of 1 January, but have a look at what it's trying to do. 5-step framework to identify when revenue should be recognised. Contract or mutual commitment. We've agreed on something. What we need to do under the contract is identifiable. The payment terms are identifiable. There's some sort of commercial value involved in the transaction, and it's probable that we'll collect. So in other words, what accounting standard setters are trying to do is try and introduce some criteria that firms can use to apply a consistent approach to revenue recognition. I'm going to show you in the next few weeks what can happen when firms don't record revenue in the right way. And knowing what you know now, you might say, oh, well, they're going to be a bit complex. They're not going to be complex. Right? And with 3 or 4 weeks, if we're going to do them in the next couple of weeks, 3 or 4 weeks of experience in accounting, you're going to see why they're not reasonable straight away. So this is a real issue. Why? Because if left alone, companies are recording too much revenue when in fact they probably shouldn't record. Not all companies, but some. And if they record more revenue, people like us look at their financial statements and go, you beauty, let's invest in shares. And if their revenue is higher than it should be, then we run the risk of losing money. That's the problem. Okay? So again, even if you sort of scribble a little bit of a scribble there, the essence of this new standard is to try and reduce the amount of judgment that firms can exercise in recording revenue to make it consistent across companies. Expenses? Well, there's no such sort of additional guidance with expenses other than to say, no such additional guidance over and above what we've talked about before. Decreases in economic benefits, somehow you're worse off after having incurred an expense. You've used something up. All right? So if, and I'll say if, but read that as when. So if you get a question like this on the exam, i.e. when you get a question like this on the exam, and if I give you a scenario where there's a choice between an expense and an asset, the key for you to determine will be whether or not you've used something up or whether there's future economic benefits involved. Or I might give you something with a revenue or a liability. And the key would be whether the criteria involved in IFRS 15 is satisfied or whether we've got a present obligation to do something. Okay? There will be some sort of question on either one of those on the exam. Okay. So in summary, just on this, on this point, in summary, it's really the timing of the recording of revenues and recognitions that gives rise for the need for judgment. The timing and the need for judgment around the timing arises because we need to report performance within particular periods and we're using accrual accounting. Okay? So why does this judgment affect us? What happens and what practical or technical elements do we need to bear in mind in exercising the judgment? Well, the key thing that I wanted to talk to you today about is adjusting journal entries, right? Adjusting entries. So adjusting entries are an example of a technical step that companies go through. Most companies go through that use accrual accounting. They go through at the end of the month just to make sure that revenues and expenses are measured correctly. Okay? And there's assets and liabilities, but the key is to make sure revenues and expenses are measured accurately. Okay. There's two main types of adjustments that we need to make. Right? And why do they arise? Well, they arise because the cash from a transaction might flow to us or from us at a different time than we earn the revenue or incur the expense. And where that happens, we need to make an adjusting journal entry if the period ends in the middle. Okay, so for example, there's prepayments. So let's assume that, and it might be an expense or a revenue. So, and we've dealt with some of these before already. Prepaid expense, so where we pay amounts before we use them up. Okay, so we buy supplies, or we buy a 1-year subscription to our insurance, or we pay for our rent in advance. Okay, asset. At the time of the transaction, one asset goes down, cash, one asset goes up, rent, or prepaid insurance, or something like that. Okay? At the end of the period, we need to review those amounts to make sure that the amount in the asset is still what is going to provide us with future benefit If we've used some of it up, we have to expense it, and that's the adjusting journal entry right there. I'm going to show you some examples in a minute. I'm just introducing them. Another one is, again, something that we've looked at so far, but I haven't acknowledged, I haven't pointed them out that we've used them. And that is revenue received in advance. Someone pays us for an order, and we're not going to do the order until after. At the point at which they pay us, cash comes in, liability is increased because we've got an obligation to do something, perform a service, provide some goods. At the time, so when the next period ends, we need to decide whether we've earned any of that revenue. If we've earned the revenue, we need to reduce the liability for the amount we've earned, and we need to recognise the revenue. That's the adjustment. So prepayments, cash flows first. The adjustment occurs at year end or period end. The other type of adjustment is accruals, where cash hasn't flowed, but we've earned something or incurred something. They're a little easier. Let's have a look. Forgot I had a plate today. All right. So in terms of the adjustments, where we've got a prepaid expense, and again, I'm just showing you the adjustments here. I'm going to give you a couple of examples in a minute. So where we've got a prepayment, a prepaid expense, so this is initially recorded as an asset. So debit the prepayment, credit the asset, credit cash or whatever when we bought it. Okay? When we get to the end of the period and we figure out that some of that asset has been used, we reduce the asset for the amount that's been used and we debit the expense. Why? Because the expense is by definition the using up. We've used up something. So there it is there. You credit the asset for the amount that's been used and you debit the expense for however we do it. At the end of the period, if you've got in the asset the amount that we haven't yet used up and you've got in expenses the amount that has been used up, then we're good. Revenues received in advance. As we've talked about, we've shown you a couple of examples, and there's one example in the workshops this week where you receive revenue in advance of providing services. You debit the cash, you credit the liability, revenue received in advance, something like that. If you earn some of that revenue prior to year end, at year end you need to reduce the liability for whatever you've earned and you recognise revenue. And there's the adjusting ledger entries there. Okay? The likelihood of you getting an example with adjusting journal entries in the exam is 100%. All right? For those of you who weren't sure, I just gave you an exam hint. You will 100% certain get a question on adjusting journal entries on the exam. Is that good? So let's do an example. Fairly simple one, I think. Supplies on hand. Really typical. Cleaning supplies, maintenance supplies, whatever you want. Okay? We buy them continuously throughout the year. We bought on October 5, we bought $2,500, and at that point we debited, in this case advertising supplies, we debited advertising supplies and we credited cash. We do a stock take right at the end of October. Really exciting stuff. We count them up and we figure out we've got about $1,000 left. If we kept advertising supplies at $2,500 in the accounts, our assets are overstated by $1,500 and our expenses are understated. So we have to adjust. We have to show that the asset advertising supplies should only be $1,000. It's listed at $2,500, so therefore you reduce it by $1,500. That brings it down to $1,000. You increase advertising supplies expense, adjusting journal entry, tick. Okay? Again, all we're trying to do is make sure that the right amount is recorded in assets and the right amount is recorded in expenses at period end. How does it look in the ledger accounts? There's the original entry there. Debit advertising supplies, $2,500. at the end, October 31, we reduce advertising supplies by $1,500 and we recognise advertising supplies expense of $1,500. Now, if we are reporting only quarterly, October, November, December, we're not reporting again until December, we may not have to do this until December 31. This assumes that we're reporting each month. A lot of companies do report each month, at least internally. Okay. Another example of a prepayment is kind of maybe a little different. It's depreciation. So depreciation is the allocation of a cost of a non-current asset over its useful life. So, for example, a building like this, we know that buildings like this don't last forever. And the way that this one was leaking a couple of weeks ago, we thought maybe it was going to not last long at all. But it seems to have been fixed now, which is good. But the reality is that technology and buildings and motor vehicles, etc., do not last forever. And so rather than keeping them at cost, keeping them at their value until they, stop working and then they become, zero, what we do is we record part of their cost of being used up over the useful life. So in other words, while we're using this building, we record a part of the cost of the building as depreciation each year. Why? Because the carpets are going to run out and the chairs might break and need replacing and the light fittings and the technology and things like that, right? So the way we do that, and in this case, I didn't put it on the front slide, but in this case, we assume the cost of the asset's $5,000, and I just picked a figure out of nowhere, but I just didn't put it on the first slide. Depreciation of the office equipment is $480 per year, or $40 monthly. So each month, we're going to record this. Debit depreciation expense and credit accumulated depreciation, which is a negative asset. And I'll show you how that looks in a minute. So adjusting journal entries like depreciation would be, you can set them up in an accounting software package to be done each month automatically. Okay? So how that looks, there's the original entry for the office equipment there. Accumulated depreciation is a credit and depreciation expense is a debit. Now, accumulated depreciation is a little bit different, a little bit odd, in the sense that it gets offset against the cost of the asset in the balance sheet. So this is what we'd see in the balance sheet, probably this $4,960 here, but for our purposes, what we'd want to see is the office equipment less $5,000 less the 40 gives you $4,960. In a published set of accounts, you'd see this amount in the notes, and you just see $4,960 in the face of the balance sheet. All right. So really, if we stay true to the idea of the balance sheet, then the asset office equipment would be listed at $4,960, and that would be the value that we think we're going to get out of the office equipment that we've got. Now it's only $40, so we don't really care that much yet. But if we had office equipment of $5,000, then that's kind of overstating the benefits that we think we're going to get from the office equipment, really. Now, you might think, well, $40, who cares? But when you start multiplying that by, tens, hundreds, 10,000s, etc., and we've got a significant amount of office equipment, let's say the university, for example, then it starts to become a material figure, and depreciation calculation is one that we need to be really careful with. So that's prepaid assets. What about revenue? What about prepaid revenues? Revenues received in advance. So we received $120 on the 2nd of October for advertising services to be completed by the 31st of December. Now, $120 is not much, right? It's more a case of illustration. Okay? So if you think about the original entry that we would have recorded, the original entry would have been debit cash $1,200 and credit service revenue in $120 it should be. All right, make that $120. Hang on, I'll do it now. How about that? All right. $120. Okay, hope you took a picture of this one, not the other one. So then, I mean, the idea is that if we recognise, if we don't make an adjustment at the end of October, then our liabilities are overstated by $40 and our revenue is understated by $40. Okay? So the way the adjustment works is at the end of the period, we debit revenue received in advance. That's a liability account, so we're reducing the liability account. We're recording revenue for the $40 that we've since earned in October. Okay? There it goes. Accruals. And go through accruals, then we might have 5-minute stretch break, and then we'll come back and we'll make a run to the end. Okay? Accruals. So again, the difference between accruals and prepayments is with accruals, no cash flow has occurred. All we're doing is we're recognising that we've earned revenues or we've incurred expenses by the time year end comes around. Okay? And the adjusting journal entries for this case is, again, these are a little simple, a bit more simple. If we're accruing revenues, it's like if we're recognising a credit sale. You debit the asset, the receivable, and you credit revenue. That's it. With an accrued expense like a power bill or interest or salary is very, very common. Debit the expense, credit the liability. That's it. Again, what we're trying to do is make sure that the revenues and expenses are properly measured. So accrued revenues, debit, credit revenue, and debit the receivable. Once cash is received, which won't happen until the next period, by definition, you reduce the receivable and you increase cash. Let's see an example. Okay? Any type of revenue, doesn't matter. Commission revenue earned but not yet received. So we haven't billed anyone yet. We typically might not, we might not send the bill out until the end of November, and the bill might be for $400, in which case we've earned $200 of it already. But if we're reporting month on month, it's important that we get into October all the revenue we've earned for October. So, debit commission revenue receivable, you could put accounts receivable, it doesn't matter. Credit commission revenue. If we've got a commission revenue account, if you just put service revenue, no big deal. As you get more sophisticated with your recording, you would be expected to look in the chart of accounts, pick the right account and enter it. When we're starting, the substance of it is you credit the revenue, you debit the receivable. That's it. Okay? Accrued expenses. Light, interest, power, energy, energy's power, salaries, very common. Accrued interest owing on a loan of $5,000, 12% per annum. That means 12% per year. If it's 12% per year, it's reasonable to assume that 1/12 of that is each month. All right, so 1% per month, $50. Or calculate 12% of 5,000 and then 1/12 of that, $50. If we don't recognise interest expense each month of $50 and we only recognise it when it's payable, then you have all of these months, when it's paid, we have all of these months with no interest expense and then $600 interest expense in the 1 month. It doesn't reflect the way in which, if we've had access to that funding all year round. That's the point. All right. One more example before I wind it up, and we have 5 minutes. We have a 5-minute stretch break. Salaries. Very common adjustment required. Okay? Now, how do you read this? Pay period every 2 weeks from Monday the 15th, payday's the 26th. All good. But then we have people that work for us Monday, Tuesday, Wednesday of October, but they won't get paid until the 9th of November. Okay? So technically we've incurred those wages in October, and until we record them, unless we record them, expenses for October will be lower than what they should be. Okay? So then it's a case of working out the daily wage cost, which we've got here, 3 days times 400, we've given it to you. In an exam, you might have to work it out. Then the adjustment is fairly simple. Debit salaries expense, credit salaries payable. Okay, and that appears in the salaries expense and salaries payable ledger accounts. And I think it all makes sense. Again, what we're trying to do is to make sure that revenues and expenses are properly measured. Okay, let me sum this up. So I might take you a little bit to digest a table like this, but here we go. I'll give it a try. So in this first column, we've got the type of adjustments. Okay, so with prepaid expenses. Now, let me throw a slightly curly one at you. It's possible that with something like supplies, I might give you information that a company records its supplies and it expenses them on purchase. So we buy $1,000 of supplies and they record it all as an expense. Oh, hang on, at the end of the month, they've got 200 left. In that case, what you'd have to do is reduce the expense and increase the asset for 200. What your aim is to make sure that whatever is done, you need to have $200 in asset and $800 in expense at the end of the period. Okay? Now, I haven't got a whiteboard here. So again, if the company initially records an amount as an asset and some of that is used up, now if we don't adjust, assets are overstated and expenses are understated. So therefore the adjustment is debit expenses and credit assets. If the amount is initially recorded as an expense, all of it, and some of it is not used at period end, some of it's not used. If we don't adjust, expenses will be too high and assets won't be high enough. Debit assets, credit expense. I could give you either scenario. We're going to be working with both scenarios in the next couple of weeks. Okay? Revenues received in advance. Some companies might book them all to revenue straight away, or they might book them all to liability straight away. It doesn't matter. The key is to figure out how much has been recognised at year end, how much has been earned at year end, and therefore that's how much should be in revenues. The rest, liabilities. So, if the amount is initially recorded as a liability, and some of it has been earned, if you don't adjust, liabilities will be too high and revenues won't be high enough. So you'll have to you'll have to record revenues, increase revenues and decrease liabilities to make it right. If the amount is initially recorded as a revenue and some of it hasn't been earned, then you have to back out the amount that hasn't been earned and you have to increase liabilities for the amount that hasn't been earned. Accrued revenues and accrued expenses, I think, are a bit more straightforward. Does this make sense? Let's take 5 minutes. All right, I make it 6:10. All right, I'll start about 18 past 6, all right? Take 10 minutes. Stretch 10 minutes. All right. It's amazing. It's amazing how quickly 10 minutes goes, right? You compare 10 minutes. You compare 10 minutes when I say you guys talk for 10 minutes to when you look at your watch and go, there's 10 minutes of the lecture to go. One really slow, one really fast. Like the 10 minutes of the last lecture goes like that because it's that exciting, right? No, okay, I'm kidding. I had a couple of good questions there. I want to share with you one of those questions, and it was, what was it? Oh, that's right. I forgot. Yeah. About extra questions, extra practice questions. So, can I have the solutions? Well, I'm taking a bit of creative license here. Can I have the solutions for all questions in the textbook because I want to do more practice? As encouraging as I am of that kind of thing, I would rather you didn't. I can't give you out. We've told the publishers we can't give you out all the solutions to all the practice questions anyway in the end of the chapters. But that aside, what we're trying to do is focus you on learning some key concepts, not rote learning by practicing. I know some of you prefer to practice lots and lots of questions, so we've put a lot of questions on Wiley Plus for you to practice. They give you the technical capability, the technical foundation for understanding the material in the subject. Have faith, trust the process, that we've been through this a bit. We're monitoring and let's go with monitoring the level of practice questions we give you early. As the semester goes on, we'll start to make available previous exam questions, and we'll do that about week 7 or 8, something like that, where you've got enough information that you start to raise your eyes and look ahead and start practicing more sort of exam type questions. We are definitely preparing you to understand a body of information and a body of material. We're not teaching you to rote learn a whole bunch of practice specific questions, because the reality is the questions you get at the end of the textbook are not the questions that you will get when you graduate and you apply this in the real world, whatever that is. Okay? So we're drip feeding you questions, if you like, to develop your understanding that you, by the time you get to the end of the semester, you'll be able to apply that in a whole bunch of different scenarios. So if I can just plead with you to not worry that you can't do more practice at the moment. If you get to sort of halfway through the semester and you want more practice, I'm happy to meet with you and give you the odd question or two here and there for you to go through. But I'd be happier. Let's go with happier. happy. I'd be happier if you just focused on understanding some key concepts and being able to kind of take the hints that I'm giving you and make arguments about, cash versus accrual accounting and things like that. Because the bottom line is, we are not going to ask you exactly the same formatted questions as you get in the textbook. We're not going to put them on the exam. That's the reality. We're going to ask you questions that require your understanding of stuff to be able to. Okay? Is that good? I don't know. But anyway, so hopefully that makes sense. Does that make sense? All right. We had a few. Yeah. All right. So where are we at? So the good news and the bad news. So the good news is that we have done the intellectual grunt. We've gone through the biggest challenge for this session tonight so far. That's the good news. The bad news is we've got a little bit to go, but I think what we can do is kind of get you to think about some different stuff now. All right? So here we go. Let me try. So once we've done the adjusting journal entries, so there's a little bit to do. So if we ran a trial balance after the adjusting journal entries, it would look like this. And so this is a fairly common kind of scenario. So you do all your recording, you run a trial balance. You do your adjustments, you run the trial balance after your adjustments to have a double check. So if you think about, so these columns here are the trial balance that we ran at the end of the period, and then we make some adjustments. So as you can see, some accounts for specific line items have changed. So there's the advertising supplies. Remember how we reduced them by $1,500. Prepaid insurance. There's some other adjustments here that we haven't shown you. Right, but some of the ones we've just recorded, there's your accumulated depreciation, and down the bottom there's the depreciation entry. Right, there's commissions revenue. We recognise some commissions revenue, which reduced. It was part of the reason why we reduced service commission revenue liability as well. So the bottom, the point I'm making is you can run a trial balance after the adjustments, and you can then verify that the accounts have changed in the way that you think they should have changed. right, and be under no doubt the role of the trial balance. I've just finished, and last night I just finished auditing, honorary auditor, might I say. I audit a couple of Probus clubs, they're called. They're sort of retired people. They get together, they form clubs, and they do all these activities. They typically want someone independent to look over the books to make sure everything's all right. I just finished auditing their books, one of them last night, and I went through the trial balance and had to trace back all the adjustments that they made to make sure that they were properly accounted for. So all I'm saying is, after having done accounting, if you guys are involved in clubs, involved in sporting clubs or gyms or something like that, you may well get asked to do something like that, and you will typically see something like this happening. So just know, you check and you go 30,190, it balances, then you've got a basis for reviewing the amounts that have changed between the trial balance and the adjusted trial balance to make sure that they all make sense, particularly where the system is maintained manually. All right, so once the adjustments are done, what next? Well, what next is where the fun stuff starts, right? We get to produce the financial statements. So the income statement's prepared by just taking from the adjusted trial balance, all the revenue and expense accounts, you just slot them straight into the income statement. The assets, liabilities and equity accounts get slotted straight into the balance sheet. There's a little bit of calculation involved with the retained profits, then you're done. You get something like this. Now, just use that, even if you just sort of use this as a benchmark for looking over some stage down the track. So let me kind of share with you how I would encourage you to use a slide like this. What does it tell you? Well, it tells you, for example, that all the assets and all the liabilities, the revenues and expense accounts are all clumped together in the trial balance. You will get a question, and I can even tell you that it will be question 2 on the exam, that will have a trial balance. It will ask you to do some adjusting journal entries on the trial balance. Some adjusting journal entries. You will then need to produce financial statements. These steps are critical. Okay, so you won't have 2 pages on the exam like this, like these ones, but you will have to go, all right, cash goes in, cross it off. Advertising supplies, or it might be inventory, or it might be accounts receivable, whatever the next asset is. Asset, put it in the balance sheet, cross it off. Okay? A couple of, not tricks, but you might want to think about things like whenever you've got non-current assets, so property, plant and equipment, machinery, office equipment, things like that, look for accumulated depreciation. Put 1 less accumulated depreciation, you provide a total. All right, where you're doing a question like this, if you provide total office equipment or written down value of office equipment, 4,960, and you do it correctly, you'll get a mark for it. But if you do it incorrectly, you don't get a mark for it. But if you do it like this, and you put in 5,000 less 40 equals 4,860, so you make an error, right? You've only made a part of an error, you probably get half marks for it still, if not more. So all I'm saying is when you're thinking about doing problems like that, do them providing more information about what you're doing so we can see it, because we do go looking for marks. We don't mark them looking where to take marks off. Okay? We don't start at 100 and take marks off, we start at 0 to give you marks. Am I making you feel better? No. Liabilities. So liabilities, Typically, you will arrange these according to whether they are current or non-current. We haven't got enough information here, but clearly, office equipment, it's inferred that office equipment is non-current. Okay? We don't know enough about the bank loan, but if anything, the bank loan would be the one that would be non-current. It's possible that the bank loan is getting paid off over time, in which case the portion that's due within 1 year would be current and the rest would be non-current. What else? Share capital. Equity. So equity, retained earnings is going to be the problem, or not the problem, but it's going to be the challenge. So retained earnings will be beginning retained earnings plus profit minus dividends. Okay? So beginning retained earnings here is 0. That tells us that this is the first month. So this is straight out of the textbook, this example. It tells us that it's the first month. So you can recreate it. So if you take service revenue of 10.4 plus commissions revenue of 200, then you take away all the rest of the expenses and then dividends, you will get 2,360 retained earnings. Okay, so the way in which you do these in an exam, you do the income statement first, because then you need profit. You get your profit, then you can calculate retained earnings, you do your balance sheet, and then if required, you do your cash flow statement after that. Okay? So the exciting thing is, this is the account. This is the end of the line. I mean, I'm going to show you closing accounts, right? But this is the end of the line. This is how we calculate. We've now gone from the original transactions to the financial statements. Now the learning curve is officially starting to flatten. Okay. So there's a couple of technical things we need to do right at the end of the period. All right, I'm going to show you those quickly, and then I'm going to talk to you about quality of income, quality of earnings, and then we're done. Okay? So there's stuff we need to do. Stuff we need to do at the end of the period. Now, in the Probus books that I talked about, what they do, they keep a cash book, and then they keep income and expenses, right? And they've got this, it's really lovely writing, like really old, old style writing. It's lovely. And they've got columns for each of these, and it's fabulous. And at the end of the year, they just take a red line, they go like that, and then they total up, probably on paper and pen. They total it all up, and they put the figures down there. What are they doing? They are ruling a line and getting the balance of the accounts. Right? They're technically going, all right, on the 28th of February at 5 o'clock, that's essentially the end of the year. They're ruling a line and calculating the amounts for the year. That's exactly, well, almost exactly, what businesses do. The technical term for that is closing the books. All right? So just the way in which you do it is slightly differently according to whether it's a temporary account or a permanent account. By a temporary account, we just mean it's a flow account, so it's an income, an expense, or a dividend account. So it just relates to 2 periods, the start and the end of the period. Or a permanent account, assets, liabilities, equity. So the balance today will be the opening, at the end of the day today, will be the opening balance at the start of the day tomorrow. So it's just slightly different. All right? So the way in which we do, I'm going to show you what we do for the temporary accounts, because I've already shown you what to do for the permanent accounts. We add up both sides, we total the side that's highest. We put the total in both sides, whatever's highest, and then we add the amount and we bring it forward to the next period. I've shown you that already. I think I showed you that last week. No big deal. All right? What I'm going to do, though, is I want to show you closing entries. Closing entries for temporary accounts. Why? Because temporary accounts, we must reduce them to a balance of 0 at the end of the periods to start again next period. The revenues we earn in October aren't relevant to the revenues we earn in November if we view them each separately. Okay? Sure, we add them together for the whole year, But more, I guess a better example is BHP's revenue for 2016 just means they want to record revenue for 2016. They don't want to include any 2015 revenue in it because that's already been done. So the way in which a company closes its books and gets it ready for next period is to prepare closing entries. So each revenue and expense account is transferred to an income summary account. The income summary account is closed off to retain profits. Let me show you. Now this is just a random example that I wanted to show you. So let's assume for a minute we've got a whole bunch of revenue accounts, one of which is service revenue. So during the period we've recorded a whole bunch of service revenue such that the balance in the service revenue account is $10,600. So we want to reduce that to a balance of 0 to transfer it to retain profits. So we debit sales revenue account to wipe out the balance because the balance up to then was credit, and we transfer it to an income summary account. So far so good. So the income summary account's now got a balance of $10,600. We do the same for all of our expenses. In this case, it tells us we've got supplies, depreciation, insurance, etc., etc. So we credit all of them because their balance up to now was a debit. So we credit all of them, we wipe them out to 0. And we put them in the debit side of the income summary. So now the income summary's got on the debit side all the expenses and on the credit side all the revenues. Really clean, right? So now we've got to figure out which one's higher. And you can kind of tell which one's going to be higher because we've credited the income summary account for 10.6 and we've debited it for 7.740. So the income summary tells us that credits are $2,860 more than debits. In other words, we've earned a profit. And we can see that because it's got $10,600 in revenue and $7,700 in expenses. Then all we've got to do is close the income summary off to retain profits, and we're done with revenues and expenses. Okay? So there's the income summary account getting closed off to retain profits. And all we do is do the same thing for dividends. So this assumes, and by all means write little notes, this assumes that during the year we've paid $500 in dividends. That's dividends that we pay in any particular period must be closed off to retain profits at the end of the period. Dividends has got a debit balance, you credit dividends and you debit retained profits. Now, after doing this, retained profits is updated. All revenues and expense and dividends accounts are closed to 0 and we're ready, the books are ready to start the next period. Okay? We can do a post-closing balance if we need. And if you did one then, it wouldn't look like, it'd sort of look like this one, but all of these would be 0, and your retained earnings figure, your retained earnings balance, see in this one, the retained earnings is 0, yeah? If we did it now for, let's say these were the figures. It's a different example, okay? But if these were the figures, the retained earnings balance would be 2,860 minus 500. That would be the closing balance. Okay? All right, and there is a summary of the accounting cycle. You made it. You made it through to the end of the accounting cycle. Now, if some of you, and don't lie, I won't ask you because then you won't have to lie to me, but I suspect some of you would have approached the thought of doing an accounting subject by thinking, oh no, process. We are done with the majority of process now. Okay, it now goes back to the background. We keep on making sure you're, like, you know, there'll be a little bit of practice, but we move now towards using the information. Okay, which is good, exciting stuff. Let me just talk to you a little bit by way of, try and stretch your understanding or build on your understanding. Talk to you a little bit about this stuff for 5 or 10 minutes and then we're done. Okay? So, if you think about what we've done, we've recorded the financial performance for the period, and that's okay, and we've used accrual accounting. We've got enormous amount of information at our disposal now. So we've got revenues and expenses, we've got profit or loss. At the same time, we're calculating cash flows as well, and we're calculating a balance sheet. So what do we do now? The reality is as well, let me start another way. So one of the things that I do, and a lot of my colleagues do, and a lot of my colleagues in finance as well, some of you guys are studying finance, so a lot of my finance colleagues, is we examine how markets, so stock markets, react when companies disclose information. Okay, so if a company earns $1 extra or earns 10% more return on equity, for example, how does the market react and why? Share price goes up, share price goes down. Why? One of the reasons, and there is no doubt that the markets react more strongly to a 10% increase in earnings for some companies than they do for others. Okay? Why? Really pretty interesting question, right? Because if we knew that, that's the kind of the holy grail, and if we knew that, we could make money, serious money. Bad news is we don't know yet. That's okay. One reason is the quality of their earnings. So one measure of the quality of their earnings, once we've done all of this, we've got our accrual accounting profit, we've got cash flow, we can start to think about how to understand how to understand the quality of earnings. And one measure is the relationship between profit and cash flows from operations over time. Not any particular period. So any particular period, cash flow from operations might be this high and profit might be this high, or vice versa. But over time, you would expect them to even out. Right? So you look at things like whether profit is way higher than cash. If profit is way higher than cash flow, so profit is way higher than cash from operations, it tells you something about the sustainability or the survivability of the company. If profit is lower than cash flow, it might tell you that the company's got a big upside, right? Potential huge, right? What you're looking for is a fairly constant relationship between profit and cash flow. They need not be equal in any period, but it's not a volatile relationship. You're also looking for a fairly consistent relationship between sales and profit. You don't want to see sales going up and up and up and up and up and profit staying about the same, which tends to suggest that either sales are being recorded more aggressively or expenses are blowing out. Okay? You don't also want to see a rapid increase in sales and receivables. So you go, oh, wow, sales have increased by 50% this year. And you go, fabulous. And you go, wow, receivables have also increased by 50%. Okay, so we don't know whether we're going to collect them. All right? So I won't go too much. I'm going to talk about conservatism in a minute. I won't go too far into this. All I'm saying is the next level of sophistication we're going to get to with you is sharing ideas about how to really understand the performance of a company over and above simply looking at the profit. Profit's gone up, gone down, good, bad. There's more to it than that. Right? How do we know that the profit of a company tells us anything about what the profit's going to be next year? Is this fundamentally good performance that we can expect to go on for next year or not, and how do we know? One dimension of profit, one dimension of quality of earnings is whether or not the figures have been put together are conservative. You know, all these jokes about conservative accountants. Accountants by nature, well, the role of accounting by nature is to provide understated is not the right word, but a useful and not overstated view of the performance of the company. If you say profit is $1 million and it really should be $100,000, then you run the risk of people investing in your company and losing their money. One of the cases, or one of the questions in this week's case, in this week's workshop, is that profit is lower than what it actually was. And that's no good either, right? But the downside risk is less for investors. Because the worst you're going to lose if you invest in a company and profit is actually higher, or the worst you're going to lose is maybe the extra profits you would have earned if you had have invested more. So there's a bit of an ethos, there's a bit of an undercurrent in accounting that slightly conservative figures are a little bit better. Because if you are a lender, you're a bank and you lend to a company and they say, well, I've got assets of $10 million, and you know that their accounts have been are quite conservative, then the current value of the assets might be $15 million. But if they're not conservative, like they didn't, when I was at uni, a few years ago, when I was at uni, it was, a lot of these companies were, the economic prosperity was huge. And asset values were through the roof. And markets were really running hot. Interest rates were really big. Really big. Okay? Asset values were enormous. And all of a sudden the bottom goes out of the market and the asset values go up from here. That probably didn't translate well on the recording either. Right? But that's an example of non-conservative accounts. People invest when the asset values are high and companies are valued high. The bottom goes out of their valuations and all of a sudden these people are left with no security for their debt or no security for their entitlements. So conservative numbers, slightly understated numbers, are generally thought to be of higher quality. But again, the relationship between profit and sales and rapid growth is another story that I may have shared with you or not, I'm not sure. Let me give you two sets of figures. Now, very famous example, and I'm going to give you less famous examples as the weeks go on. Enron, 1995, and I quote these figures. Sales in 95 of 9,189 million, so 9.19 billion, okay? Profit, 520 million. Profit margin, 5.6%. Okay? All right so far? The year 2000, so 5 more years. So sales have gone from 9.1 billion to 101 billion. Okay? So tenfold increase in 5 years. Giddy up. Profit 970 million, so profits doubled. Sales have gone up tenfold. The profit margin, 0.97%. 0.97 of 1%. So profit margin has gone from 5.6% to less than 1% in 5 years, even though sales have gone up tenfold. All right? So you guys are thinking, it's clearly not right. Yeah? You've only been at this 3 weeks, it's clearly not right. And you are absolutely correct. It's clear they were recording revenue when they should not have been recording revenue. All right? Their expenses were overstated. There was an environment where they were not forcing each other, but they were sort of almost compelled to sort of record higher revenues than before as each year went past because they'd set the bar high. Right? It was an absolute train wreck. We all know what happened, or we know a little bit about what happened. I'm going to talk to you more about that as we go. But it wasn't until 2001 that the company went into real difficulties. How can you not have seen it? How can investors not have seen it? And it's a simple one. Revenue was going up like that and profit was going like that. Something's amiss. Okay? Obviously I'm untangling it. There's volumes and volumes of material on this. It's really complex. I'm happy to talk to you about famous cases like that. I will be sharing with you some examples as we go through the semester, but I'll be drawing it back to the messages that we can get. And that is, there are some really easy things where you can look at balance sheets and income statements and look to see whether or not they make sense, whether or not they seem right. And that's the art part of analysis. Some of it's science and some of it's art. Hopefully we'll get you to appreciate both. Anyway, normal things, normal sort of additional resources in the textbook. Please tick off, make sure you can resolve the objectives for this week. I will start the workshop about 7, and we'll be in the same room as we were last week, to the room next to where we should be, because I think someone's in it. See you next week.
Can I ask you some questions?
Sure. I've got to work.